Hello, in this video we're going to look at corporate redemption problems. We're going to talk about the tax consequences of corporate redemptions. This is problem number 1. Now, one thing before we go through these problems, you're going to see the same fact pattern. So the facts are going to be the same, but we're going to have 4 different variations, and that's all going to be problem 1. So let's go ahead and read the actual problem basic set of information facts. So Fruit Smoothie Corporation has 100 shares of common stock and 200 shares of non-voting preferred stock outstanding. Blueberry owns 70 shares of common stock, and Mango owns 30 shares of common stock. Mango also has 100 shares of non-voting preferred stock. Now, Fruit Smoothie Corporation has current earnings and profits of $500,000. So variation number 1, okay, so we're going to have 4 different variations. This is variation 1. Fruit Smoothie redeems 5 shares of common stock from Mango for $5,000. Mango's basis was $900 per share. So remember what's going on here. And by the way, because we're doing 4 different variations, some of the basic information, just understanding, will be discussed in the first one, and then we go through number 2, 3, and 4. We're not going to go through all these different things to understand what exactly is going on. We're dealing with corporate tax issues. We have to worry about the corporation as well as the shareholder. That's what corporate tax is all about. So we have a redemption here. Redemption means that Mango is selling her shares, his or her shares, back to Fruit Smoothie in exchange for $5,000 cash. So specifically, we have to look at Section 302, the Section 302 redemption rules. And remember, Section 302 treats a redemption one of 2 different ways. It either treats it as a Section 1001 sale or exchange, or it treats it as a Section 301 distribution. The way that we know whether it's treated as Section 1001 or Section 301 is that if it meets 4 different tests, one of 4 tests, it's going to be treated as a Section 1001 sale or exchange, where we take amount realized minus adjusted basis. If it doesn't meet any of those 4 tests, it's treated as a Section 301 distribution, and we apply the corporate distribution rules. Now, looking at the facts, the main set of facts, which again do not change for the problem, okay, the main facts. There's a few things to notice. When we're doing this analysis for the 4 tests, the first thing is that we have this non-voting preferred stock outstanding. The non-voting preferred stock outstanding. That's the first thing that you should probably notice. In our 4 tests, the non-voting preferred stock outstanding has no impact. We're just going to focus on the impact of the common stock. That's all we're going to worry about. So we're only going to worry about the 70 shares of common stock that Blueberry owns and the 30 shares of common stock that Mango owns. Because all the tests that look at whether it's treated as a Section 1001 sale or exchange or Section 301 distribution, those 4 tests, they all focus on the common stock, voting and non-voting, but again, on the common stock. So the preferred stock in this problem that Mango owns and the total preferred stock, that's a red herring. It's not relevant to this problem. Keep that in mind. Okay, so let's go through the 4 tests. Let's just talk about them in order. The first test is substantially disproportionate. Remember that this test is purely mechanical. It's got 3 tests where we look at ownership percentage. The second test is going to be the complete termination test. Complete termination, the owner has to get rid of not only direct but also indirect ownership completely. Now, there's a special waiver rule for family attribution that's unique to just this rule, complete termination, but we don't have any family members here because the problem says specifically nothing about how Blueberry and Mango, how the relation, which if you're not told the relation, you should always assume they're unrelated unless you're told specifically in a problem that they are related. That's very important. Okay? So here, we're going to see in all 4 variations that after the redemption, the shareholder, here Mango, and you're going to see later Blueberry, still has ownership, direct ownership. So complete termination is never going to be an option because you have to have all direct ownership is relinquished and indirect. Again, with the exception that you can also use the family attribution rule waiver. Okay. The third test is partial liquidation, which does not apply here. There's no facts here about the corporation potentially liquidating in the future or a partial liquidation plan. So we're not going to be considering complete termination and partial liquidation in this analysis for the 4 variations. Finally, the 4th test is not essentially equivalent to a dividend. That's always the last test, and we'll be looking at that one in all of these different fact patterns because that one's the last one. We'll be looking at it if we don't meet number 1, 2, 3, or 4. So to recap, we're going to be starting with number 1, substantially disproportionate for all of these. Test 1, okay? Test number 1. Again, I'm going to be going through the tests and the information with you through the first one, but then when we get to the 2nd, 3rd, 4th variation, we're going to be going a lot faster through the facts just to do the analysis because you have a good idea of how to analyze. The 2nd and 3rd test, complete termination and partial liquidation, not relevant to this fact pattern because Mango still owns shares of stock after, and you're going to see that's going to be the same thing after for all the other variations. Mango and Blueberry still own stock after, and then again, there's no partial liquidation plan in place. And then the 4th plan, not essentially equivalent to a dividend. So if test 1 isn't met, and because test 2 and 3 fail, test 4 is then considered if those aren't met. So we're going to go in that order. So test 1 is substantially disproportionate. Substantially disproportionate. And as I mentioned, this test found in section 302B2 is a purely mechanical test. Okay, substantially disproportionate. So this test, you have to meet 3 tests within. You have to have less than 50% ownership. Again, we're focusing on voting stock for this one. Voting common stock after. Less than 50% after. Okay, it has to be less than 50% after. Second is that the shareholder after, okay, the after percentage is less than 80, this is a formula, 80% times the before percentage, okay? And that is with respect to voting common stock. And finally, the 3rd test that also has to be met, it's the same thing. The after percentage is less than 80% times the before percentage, but it's all common stock. All right, so we have that. We have those 3 tests. Let's go ahead and let's apply these 3 tests to this fact pattern. So we're looking at Mango. We're focusing on Mango in this problem, this variation. Okay, not the problem. You're going to see problems also going to focus on Blueberry at times. So we have a 5-share redemption. So the idea here is that Mango owns 30 shares and the corporation has a total of 100 shares. Okay, so that means that Mango owns 30 over 100 before. Okay, that's the before percentage. The way we do this is we always look at before versus after. After, Mango owns, there's 5 shares redeemed, so 30 minus 5 is 25. And what does the corporation have outstanding? Well, the corporation bought back 5 shares, so now there's 100 minus 5, 95. Okay? So we do percentages. So 30 over 100, that's obviously going to be 30%. Okay? 25 divided by 95 is going to be, and we're just going to round to 1 decimal place, 26.3%. 26.3%. So is the first test met? Yes, because the after percentage is less than 50%. So boom, we got that. We got that. And by the way, because the common stock here is all voting and there's not like differences in voting and non-voting common stock, it makes it a lot easier for this analysis, right? Because the second test is going to be the same. Second and third tests are going to be the same. Okay, now we have to do the 80%, right? After the 26.3%. So it's saying the after percentage, which by the way, again, these are both going to be viewed the same because the common stock there's no differences in common stock. It's all voting. 26.3%, the after percentage, is that less than 80% times 30%, which is 24%, right? 80% times 30% is 24%. No, is it less than that? No, it's not. Therefore, this is not going to be a Section 1001 amount realized minus adjusted basis. This is going to be a Section 301 distribution. This is a Section 301 distribution, okay? Under Test 1. Test 2, And test 3, as we mentioned, they also fail. Test 4, what about not essentially equivalent to a dividend? So not essentially equivalent to a dividend, remember, that's the one where you have to look at the significant or meaningful reduction in control. And there's 2 revenue rulings that we focus on. Revenue ruling 75-502 and revenue ruling 76-364. Revenue ruling 75-502 had 2 taxpayers. 76-364 deals with the issue of concert where you need more than 2 taxpayers. Well, since we don't have a concert issue of more than 2 taxpayers, more than 2 shareholders, right? We don't worry about revenue ruling 76-364. The concert issue is not relevant. But revenue ruling 75-502, that's the one where we had a taxpayer that went from 57% to 50% or less. So they went from more than 50% ownership to equal to or less than. Do we have that here? No, because guess what? Before was 30%, after 26.3. So before is less than 50%, after less than 50%. So it fails revenue ruling 75-502. So this would not be viewed as a meaningful reduction of control because we're focused on voting percentage. So therefore, it fails all 4 tests, and it's a Section 301 distribution. So what does that mean? It's going to have to go through the distribution checklist, right? Step 1, 2, 3, 4, right? We have EMP or $500,000. So it's going to be a dividend to Mango, and it's going to reduce accumulate EMP next year by the full amount, by the full amount of the $5,000. Now, last thing I want to mention, the adjusted basis. The adjusted basis of the shares going forward, okay, has to be recalculated. Now, the total basis, we're told, is $900 per share for 30 shares. Again, Mango owns 30 shares, right? Mango owns 30 shares. That's going to be $27,000. What the rules do is they take that basis for the total shares, 27,000, the before amount. And when you have a distribution, we reallocate that using the after amount of shares. So that's 25 shares. So 27,000 total, which was the before total for all 30 shares, divided by the 25 shares left. That gives us a basis of $1,080 per share. That's important. So to go through, we fail all 4 tests. So it's a 301 distribution. It's going to be a dividend of $5,000 to Mango. And then we accumulate EMP of next year, which is going to, the $5,000 reduces the EMP for next year. So it'd be $500,000 minus $5,000, assuming there's no other transactions. So it'd be $495,000 EMP rolled over next year, assuming no other transactions. Okay? And the adjusted basis that Mango has in the remaining 25 shares, right, after the redemption, is going to be $1,080 per share. Okay, so that is variation number 1. So now we have variation number 2. Variation 2. So the facts are still the same from problem 1 up to this point. Still exactly the same, nothing's changed. Variation 2. In variation 2, Fruit Smoothie Corporation redeems 10 shares of common stock from Mango. So we're still focusing on Mango. 10 shares redeemed for $10,000. Mango's basis per share was $1,200 per share. So that's important there, okay? $1,200 per share. All right. So the analysis is still the same. We still go through the four tests, the complete termination test and the partial liquidation test. Still going to fail because, again, Mango still has ownership after and there's no partial liquidation plan. So we're going to start by going through the first test, test 1, substantially disproportionate. So test 1, the SD, substantially disproportionate test. And remember, we have the 50%, right? We have to have less than 50%. Okay, after. We have to have the after percentage is less than 80% times the before when it comes to voting. And by the way, the 50% test is a voting test. Voting. And then the after percentage is less than 80% of the before of all common stock, which again, these two for this problem are the same because there's no differences. All right, so we're looking at Mango, okay? So the before, again, what I like to start with is looking at before versus after. So the before is going to be 30 shares, right? Because there's 30 shares out of 100 outstanding. So that's 30%. The after is going to be 30 shares minus 10 shares, 20 shares over 90, right? Because there's 100 outstanding, but 10 are now redeemed. 20 over 90, 20 divided by 90, that equals 22.2%. Again, we're just going to one decimal place. All right, so let's apply the test. The after percentage, is it less? This is after, by the way, sorry. After percentage, is it less than 50%? Yes, it's 22.2%. All right, the after percentage, is it less than 80% of the before? So let's test that. The after percentage is 22.2%. Is that less than 80% times 30%, which is 24%? Yes. So this is 24%. So 22% is less than 24%. So yes. And that's for both of these tests, right? That's for both of these. So guess what? We meet all three tests, and therefore, this is a Section 1001 realized gain, amount realized minus adjusted basis, and going to be capital gain or capital loss, okay? So our amount realized is going to be the amount received, which is $10,000. The adjusted basis is going to be the number of shares redeemed, which is 10, times the basis per share, which is 1,200. So that's $12,000. This gives us a $2,000 loss. The character of the loss, because Mango's selling stock, assuming Mango's not a broker or dealer in securities, is a capital loss. Let's assume that the loss was held for the stock's been held for more than a year. So this is going to be long-term capital loss. Now, when you're given a fact pattern in your class or my class or whatever, it'd be more information to know how long the stock's held, short-term or long-term. But we're going to assume it was held for more than a year, so long-term capital loss. So the $2,000 loss is a long-term capital loss to Mango. The last thing to determine, the adjusted basis of the 20 remaining shares stays at $1,200. $1,200 per share. Okay? So when you have a Section 301 distribution, the basis gets reallocated, all right? When you have a sale or exchange, it stays the same for the remaining shares. Okay? And we have a sale or exchange here. Okay, whether EMP goes down, goes up is a factor of we have the sale or exchange that could reduce earnings and profits technically based on what's going on here. All right, but we're not going to look at that specific issue. So that is the consequences here. We meet the first test, substantially disproportionate, and therefore it's treated as a sale or exchange. We stop and we have sale or exchange treatment. $2,000 long-term capital loss. Adjusted basis is $1,200 per share. All right, so now this is variation 3. Again, the facts are still the same. This is variation 3. So now we're dealing with Blueberry. No longer are we talking about Mango. We're focusing on Blueberry. So Fruit Smoothie Corporation redeems 35 shares of common stock from Blueberry for $35,000. Blueberry's basis was $900 per share. So we're going through our tests. Okay, again, complete termination and partial liquidation fail for the reasons described above because Blueberry still owns stock after and there's no partial liquidation plan. So test 1, substantially disproportionate tests, okay? We have to meet the 3 tests, okay? The after percentage has to be less than 50%, okay? And by the way, earlier on when I went through the I think in the first variation, if I had that wrong sign there, again, it's supposed to be after percentage is less than 50%, not greater than or equal to 50%. After percentage is less than 50%. Second thing, the after percentage is less than, I think what I did on the first one is I think I put before percentage, I put after, but I put like 50%. I put like I flipped like the direction, so it still means the same thing mathematically. But again, after percentage is less than 50%. Second test, after percentage is less than 80% times the before percentage when looking at voting common stock. The last test, after percentage is less than 80% of before. of all common stock. Okay, all common stock. Okay, so here we have Blueberry. Before the transaction, Blueberry owns, sorry, my apologies, that's wrong. Blueberry owns 70 shares out of 100 shares outstanding. So the before percentage is 70 over 100, which is 70%. After percentage, that's where I was going, is going to be 70 minus 35, which is 35 shares, over 35 redeemed. So 100 minus 35, that's going to be 100 minus 35, that's 65. So again, we had 70 shares owned by Blueberry minus 35 redeemed, 35 over 65. So 35 divided by 65, that's going to be 53.8%. Again, going to one decimal place. So we go through our tests. We failed the first one. So it is not going to be substantially disproportionate. We can stop right there because the after percentage is not less than 50%. Again, tests 2 and 3, complete termination, partial liquidation, not met here. So we go to test 4. Test 4, not essentially equivalent to a dividend. NEED 302B1, we need a meaningful reduction in control. Let me tell you, anytime that the after percentage is greater than 50%, not essentially equivalent to a dividend, is going to fail. Just simply because we have more than 50% where we still have the ability to exert control, to exert influence, significant influence. So this fails. So not essentially equivalent to a dividend fails. So we fail all 4 tests. So what does that mean? It's going to be a Section 301 distribution. So all $35,000 is going to be, because we have ample earnings and profits, is going to be a $35,000 dividend to Blueberry. That's going to reduce EMP if there's no other transactions. 500,000 EMP minus 35,000 dividend is going to be $465,000 EMP rolled over next year. And finally, the basis, the adjusted basis of the shares going forward. What will we do whenever we have a 301 distribution with one of these 302 transactions? We take the number before. So we have 70 shares outstanding times 900. That's the before. That's 63,000. The $63,000 before, we divide that by the number of shares that are left. So 35 shares are redeemed. So 70 minus 35, we have 35 shares left over. So $63,000, that was the basis, divided by 35 shares left over, that gives us $1,800 per share. The new basis per share of the remaining 35 shares is now $1,800 per share. And that's what Blueberry takes in those shares. And that's the consequences with respect to this transaction. All right, so the last variation, we made it. Last variation, variation number 4. So we're dealing with Blueberry again. We've got 40 shares redeemed by the corporation for $40,000, $900 basis per share. Same facts again. So we're going through our tests, right? This is becoming second nature now. So test 1 is substantially disproportionate, right? We have to have, you should know this by now, the after percentage is less than 50%. The after percentage is less than 80% times the before percentage when it comes to voting. And also, the after percentage is less than 80% of the before percentage for all classes of common stock. So we go ahead and calculate the before percentage. So we have 70 shares out of 100 outstanding. That's 70%. 70% before. The after percentage is going to be the 70 shares minus 40 redeemed. So we've got 30 shares divided by 100. The corporation has 100 minus 40, 60 shares outstanding. This equals 50% exactly. We failed the test. Why? Because the rule is it has to be less than 50%. It cannot be equal to 50%. It has to be less than. So we fail the substantial disproportionate test. Well, let's go to test 2 and test 3. Test 2, complete termination. Well, after Blueberry still has ownership, so can't be complete termination. And then partial liquidation, nothing in here about partial liquidation plan. So then we go to test 4. Test 4, not essentially equivalent to a dividend. And this is actually going to bring us over. It's going to be a good transition to our next problem, problem 2, where we focus on not essentially equivalent to a dividend. So not essentially equivalent to a dividend, remember we have the 2 revenue rulings. The idea is that you have a meaningful reduction in control. Revenue ruling 76-364, which is the one in concert where we have more than 2 people and you have a shareholder working together to team up to control of another person. That issue is not relevant here because we have 2 shareholders at issue with respect to the voting stock, right? Yes, there's other shareholders out there when it comes to the preferred stock, but that's irrelevant because we only care about the voting stock and the common stock when we focus on not essentially equivalent to a dividend. So revenue ruling 76-364, the concert issues, not relevant here. So that leaves us with revenue ruling 75-502. And in that revenue ruling, remember that what happened is we had a shareholder that went from 57% ownership to 50%, and there were 2 owners. Well, we have 2 owners here, right? 2 owners when it comes to the common stock, the voting stock, right? And here, Blueberry goes from 70% to 50%. So this is extremely similar because we've gone from owning more than 50% and exerting control to 50%. And that is going to be viewed as the same. So in this transaction, this would be a not essentially equivalent to a dividend. Okay, it would result in not essentially equivalent to a dividend. It would be treated as not essentially equivalent to a dividend. Okay. Now it's possible though that your instructor might view this differently, and they might view that it doesn't meet test 4. I think it does. Okay, but there's been times where I thought it didn't. All right, so this one actually could go either way, but it looks like you could argue from the revenue ruling there's a good argument. So we're going to treat it that way. We're going to treat it as a section 1001 sale or exchange. And by the way, for those of you that are in my class I have quizzes that are tied to these problems, like practice quizzes. It's possible that, again, when I created the quizzes, I might have treated differently. Okay, you could argue both ways, but here we're going to treat it as this because it's very similar to the revenue ruling, the facts of that. So just be careful when you're taking my quiz. You might see that it ends up being I treat it as a distribution, a section 301 distribution. But for here, I'm treating it as a section 1001 amount realized minus adjusted basis because I think we have a good argument. So the amount realized is going to be the amount received, which is $40,000, minus the adjusted basis, which is going to be the 40 shares redeemed minus the $900 per share. So that's $36,000. We have a $4,000 capital gain. Let's assume that Blueberry's held the stock for more than a year. Again, you'll be given that if you're taking a test or a problem. So that's long-term capital gain of $4,000. The adjusted basis of the 30 shares left over is going to be $900 per share. You always have to identify that. Okay? And EMP issues, all that stuff, I have checklists that walk you through that. But the adjusted basis of the remaining 30 shares per share is going to be $900 per share. And we are done with the consequences of all 4 variations. I hope you've enjoyed this video. Please make sure you watch the other redemptions problems that are out there because they will give you more information about various fact patterns.